The late 1990s witnessed a technological revolution that promised to reshape the world as we knew it: the rise of the internet. What began as a niche tool for academics and researchers quickly evolved into a global phenomenon, connecting people, businesses, and information in unprecedented ways. The internet's potential seemed limitless, and with it came a wave of unbridled optimism and entrepreneurial zeal. The internet's disruptive power was evident in its ability to break down traditional barriers. It democratized access to information, allowing anyone with a computer and a modem to tap into a vast repository of knowledge. E-commerce emerged as a transformative force, offering consumers unparalleled convenience and choice. This digital revolution was more than just a technological shift, it was a cultural and economic earthquake. The internet wasn't just changing how we communicated or shopped, it was reshaping industries, challenging established business models, and creating entirely new markets. As the internet's influence grew, so too did the excitement surrounding its potential. Investors, entrepreneurs, and everyday citizens were captivated by the promise of a digital future, one where innovation and technology would drive unprecedented economic growth and societal transformation. The internet's transformative potential ignited a frenzy of entrepreneurial activity. Countless startups emerged, each vying to capitalize on the vast opportunities presented by this new digital frontier. These companies, often with names ending in .com to signify their online presence, spanned a wide range of industries, from e-commerce and online marketplaces, to software, telecommunications, and digital media. Investors eager to get in on the ground floor of the next big thing poured billions of dollars into these fledgling tech companies. Venture capitalists, traditionally cautious with their investments, became more willing to back ambitious entrepreneurs with bold ideas and even bolder projections. The stock market, particularly the Nasdaq Composite Index, which heavily weighted technology companies, became a barometer of this burgeoning tech boom. As investors piled into tech stocks, the Nasdaq soared to unprecedented heights, reflecting the exuberance and speculative fervor gripping the market. This period was characterized by a palpable sense of excitement and possibility. The air was thick with the belief that the old rules of business no longer applied in this new digital landscape. Companies were being valued not on their current earnings or assets but on their future potential, their ability to disrupt established industries and capture a share of the rapidly expanding digital economy. Between 1995 and 2000, the Nasdaq Composite Index, a bellwether for the technology sector, experienced an astronomical surge. It rose from under 1,000 points to over 5,000 points, reflecting the unprecedented growth and investor enthusiasm surrounding technology companies. This meteoric rise was fueled by a potent combination of factors, including genuine technological innovation, a surge in venture capital funding, and a widespread belief that the internet would fundamentally reshape the global economy. The Nasdaq's remarkable ascent attracted a new generation of investors, many of whom were drawn to the market's potential for rapid wealth creation. Day trading, once the domain of professional traders, became increasingly popular as individuals sought to capitalize on the volatility and upward momentum of tech stocks. This period was marked by a sense of euphoria and invincibility. The Nasdaq's relentless climb seemed to defy gravity, and many investors believed that the good times would last forever. However, beneath the surface of this seemingly unstoppable bull market, warning signs were beginning to emerge. Valuations were becoming increasingly detached from fundamentals, and many companies were trading at astronomical multiples of their earnings, or even worse, on the basis of little more than a promising idea and a catchy .com domain name. Section 4. Irrational exuberance, the allure of IPOs and unproven business models. The .com bubble was characterized by a dangerous disconnect between valuations and underlying fundamentals. Many companies, particularly those in the internet sector, went public through initial public offerings or IPOs at exorbitant valuations despite having little or no revenue, let alone profits. Investors, caught up in the speculative frenzy, were willing to overlook traditional metrics of financial health such as price-to-earnings ratios and cash flow in favor of nebulous concepts like eyeballs and website traffic. This irrational exuberance was fueled by a potent cocktail of factors, including the allure of getting in on the ground floor of the next Amazon or Google, the fear of missing out on potentially life-changing gains, and the widespread belief that the internet had ushered in a new economic paradigm where the old rules no longer applied. Companies with unproven business models and questionable long-term viability were able to raise vast sums of money from eager investors. The promise of rapid growth and market dominance in the nascent digital economy trumped any concerns about profitability or sustainability. This speculative frenzy created a climate where hype and marketing often took precedence over sound business practices. Companies spent lavishly on advertising and marketing campaigns, often featuring celebrity endorsements and extravagant parties, in an attempt to create buzz and attract investors. The bubble could only inflate for so long before it burst. In March of 2000, the day of reckoning arrived. The Nasdaq Composite Index, which had soared to unprecedented heights, began to plummet. Investors, once intoxicated by the promise of limitless growth, faced a harsh reality check. The sell-off was swift and brutal, wiping out trillions of dollars in market value. Companies that had been the darlings of the dot-com era found themselves on the brink of collapse. Some of the most infamous casualties of the dot-com crash were Pets.com and Webvan. Pets.com, with its iconic sock puppet mascot, became a symbol of the era's excesses. Despite a high-profile marketing campaign, the company failed to achieve profitability and burned through its cash reserves at an alarming rate. Webvan, an online grocery delivery service, promised to revolutionize the way people shopped for groceries. However, its ambitious expansion plans and massive infrastructure investments proved unsustainable. Both companies went bankrupt, serving as stark reminders of the high cost of hype and the importance of sustainable business models. The dot-com bubble left a lasting legacy and imparted valuable lessons for the modern era. It underscored the importance of due diligence, sound financial metrics, and sustainable business practices. While the internet has undoubtedly transformed the global economy, the bubble showed that not every new technology or business model is a guaranteed success. Investors and entrepreneurs alike must remain vigilant, discerning, and grounded in reality to navigate the ever-evolving landscape of the digital age.